All right, Chapter 3, Part 2, the revenue recognition. Again, this area is probably one of the most abused areas in accounting. There's a significant amount of fraud here, which the book does not discuss, but you should be aware of this. Let me give you an example. Your CEO is just short of making bonus, and so he wants you to move some of maybe January 1st or 2nd sales into December 31st. He and maybe all the other executives will make more on their bonuses. There can be a lot of corporate pressure for you to do so. However, you would be overstating the revenues, and could be some serious legal and financial repercussions for doing that. On the reverse side, maybe you're just about to meet your profit goals, and you want to pay a lot of your month-end bills on December 31st, and he doesn't want you to record those expenses. Can you delay them till January? Again, you're understating your expenses, and maybe still overstating your balance sheet by not recording certain accrued expenses. This goes on a lot, and there's a lot of pressure to conform. Unfortunately, what the book doesn't say is about 95% of the time you're the corporate representative for the company. About 5% of the time you're the cop. And what happens when you get in conflict with your CEO here? I personally have left 4 or 5 jobs over issues something like this. And I can't tell you where to draw the line, but I can tell you there can be some serious legal repercussions here. Unearned or deferred revenues. Again, unearned revenues is actually a liability. And why I'm saying that is someone has paid you cash in advance for some future work or a future product delivery. And when do you record it? Well, obviously when you receive the cash, you have to journalize that receipt of cash, and you'll keep track of it as an unearned revenue, which is actually a liability account. As you provide those services, and a classic example here would be like magazine subscriptions. Many people buy a 12-month subscription. Well, if you're the magazine company, you don't record all that when you receive the money. As every month when you send out a subscription, you'll take a part of that and show that in the revenue account for that month. So don't get confused by the term unearned revenues and assume that this is revenue. It's actually a liability account, and it confuses a lot of students. Again, where you'll see this also, unearned deferred revenues, maybe you're selling box seats for baseball games or football games or theater tickets. There's a lot of industries that actually use this, so this is not an uncommon item. You will see this often, so get used to seeing this term. Again, consulting revenue. Sometimes you're paid in advance, an advance fee, and then as you recognize that weekly occurrence, you're gonna take off of your unearned revenue, i.e. your liability, and now move it to the revenue side. So accrued expenses. These are expenses that incur over a period of time, not as a result of a transaction. So what happens is at the end of the month, you've recorded all your transactions, and you think you're finished. Well, that's not quite how it happens. What happens is you finish your trial balance, make sure that is in balance, and now you make your adjusting entries for those expenses that have accrued over time. There was no transaction actually recorded here. And so this is now what we're doing. You're recording an expense, or maybe a liability, or you're decreasing an asset through the depreciation expense. But again, this accrued is over time. Accrued salaries is a classic example. I mean, do you pay your employees every 2 weeks or at the end of the month? What if that pay period hits in between the end of the calendar year or your fiscal year end? You will have an adjustment that you will need to make. So you'll see a variety of these accrued expenses: salary, rent, interest can be quite numerous. And what a lot of CFOs do is they just keep a spreadsheet on the side that they keep track of this, and they know they need to bring that up to date every month, so it's a tickler for them. Again, salaries expense and salaries payable. Here you're recognizing the expense on December 31, but you notice it's a salaries payable, so liability. You haven't paid your employees yet. They've incurred, they've earned that payment, but that doesn't mean you're going to actually cut a check then. And so at a later date, you will then pay it. So what will be that later point? And then see if they bring it up. They don't. So the next expense, let's say you pay on the 3rd of January. Well, on January 3rd, you'll show cash, and then you'll decrease your salaries payable. Let me get into interest expense. Classic. This happens all the time on your bonds, on your long-term notes, on a variety of accounts payable and so forth. And so interest expense adjustments will be very, very common. And so please be aware of this. Again, interest expense, interest payable, you're recognizing the expense for that month of December, but you're going to pay it at a later date. You notice there's no cash here being transaction. You're just recognizing these expenses. Again, accrued revenues, they're going to go through maybe accrued service revenue. It could be also on products. You're going to see these time and time again. So this will be on the test. You probably should be familiar with this slide. Again, you're going to have a variety of categories like prepaid expense, unearned, accrued expenses, accrued revenues, and you'll notice that it's an asset and then an expense. You're affecting both the balance sheet and the income statement, and the adjusting entry has to be to both of these statements. That's one way to know if you're doing it correct. You must be adjusting an income statement item and a balance sheet ledger account. So here's an example of we do an unadjusted trial balance, and you pay and you record all these, and now you make a variety of adjustments. You maybe have been paid off on accounts receivable, prepaid, and there's accumulated, and then you will then follow up and now do an adjusted trial balances. You notice here's one set of amounts that you totaled up, that balanced. You made your adjustments here, and then you want to make sure that those adjustments are in balance to the debit and credit, and now you do a retotal from to an adjusted trial balance. From this adjusted trial balance is where you will now prepare your final financial statements. It's not from here, it's from after the adjustments. So let's get into the financial statements. And now you will transfer these into your various financial statements. The income statement, the balance sheet, owner's equity statements. And here's what they're doing. The owner's equity, you're moving the net income over from your income statement. You total up all your revenues, all your expenses, including your accrued expenses. And now you have that net income, and that net income is transferred over to the owner's equity statement. And from there, you now can do your balance sheet. The balance sheet is always the last financial statement. And this ending financial statement will be next year's beginning financial statement. I'm not going to go into the global view. Let me just talk real briefly about a couple of key ratios that we'll use. Profit margin is used everywhere. It's very extensive. And so really what this is just measuring how much of your sales are you converting to the net income. For every sale you make, how much are you really making after you do all your expenses? And they will track these sometimes by industry, by company, and they will be tracking this. They're noticing they're making here 8%, here 5%, 2%. So you notice they've been able to increase their profit margins. And this will get into the financial analysis, which you'll do in Chapter 17. But get comfortable with this ratio. It's very commonly used. I'm going to leave it there, and that's the end of Chapter 3. Good luck with it. If you have any questions, don't hesitate to email me. And I do read the discussion board, so if I do see some things in error, I will correct you there. Thank you, and good luck with the chapter.